little bit of a dead cat bounce this morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
He's open to talks. President Trump signs a wave of threatening letters to trading partners, but delays what is now a soft tariff deadline of August 1st. Plus, Wall Street is trying to keep up with the twists and turns of Trump's tariffs, and Goldman Sachs is raising its S&P target for the second time since May. And on the corporate front, Apple's AI efforts, already fairly poor, take another blow as the tech talent war heats up in Silicon Valley. Katie, what are you looking at?
I'm looking at that stock, and there's not too much to say. It's up about 0.1% right now. Of course, as Matt just said, it lost its top AI modeling executive to Meta in a setback for Apple's AI ambitions. Meta has been on a hiring spree, an acqui-hiring spree, to accomplish artificial super intelligence, which sounds even scarier than just artificial intelligence.
Yeah, it's going to kill us, definitely, sooner than climate change. Renewable energy stocks, speaking of, like Enphase and First Solar, are falling after President Trump called for new rules that would restrict access to tax incentives for solar or wind projects that already had been pared back by his budget bill. You can see these shares getting, well, in some cases, absolutely crushed, down 6% for First Solar. Katie?
We'll talk about all that and more, but let's get back to trade, because President Trump revealing a wave of letters threatening key trading partners such as Japan and South Korea with high tariff rates. The president pushing off those increased duties until at least August 1st, and he says he's open to negotiations.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
For more, we are joined by Bloomberg Washington correspondent Tyler Kendall. And so firm, but not too firm is the deadline. What are we expected to take from this? Is it a negotiating tactic?
Yeah. Hey, Matt. Well, perhaps the administration could think that way. We know that one of the reasons why they sent out these letters to begin with, according to the Treasury Secretary, was to apply maximum pressure. They were hoping to light a fire under these trading partners to put their best offer on the table. But when we look at the rates that were actually proposed in these letters, they're not really, they're marginally different from what we saw on April 2nd. For example, some are a little bit higher. Japan, in one instance, is seeing a boost by only 1 percentage point. And many of these countries are actually facing the same rates that they were threatened before, like South Korea, South Africa, Indonesia, for example. Although probably worth mentioning that some actually did see some lower tariff rates, like Laos and Cambodia, the latter of which saw the biggest drop from 49 to 36%. I think what we can take from this is that President Trump has framed these initial letters, these initial countries, as the trading partners that the U.S. at the moment are the most frustrated with when it comes to negotiating. And perhaps that could inform how the White House looks at these negotiations going forward. You heard President Trump there saying August 1st is firm, but not firm, signaling that he's open to negotiating and that ultimately these tariff rates could change moving forward. One thing's for sure, this is all pretty fluid, Matt and Katie.
And it seems like there's just a laundry list of deals and countries that need to be negotiated. But for a lot of investors, Tyler, what really matters is the relationship with China, that crucial trading relationship. What is the current state of play?
Right. So the Treasury Secretary, Scott Bessent, Katie, has indicated that he will be meeting with his counterpart in coming weeks. We know the U.S. still has been raising concerns about those export licenses when it comes to critical minerals, which really was seen as sort of the linchpin in keeping these negotiations moving forward. And what's been particularly interesting about this round of letters, these tariffs, of course, separate from the negotiations with China, are the countries that got some of these letters and were prioritized, like Japan and South Korea, which we know the U.S. had been prioritizing for certain reasons, including the strategic ones, when it does come to countering China moving forward. Of course, these are sort of on separate tracks because the China negotiations are just totally different. But it has been interesting to see the White House try to light the pressure, light the fire under some of these Asian economies that we really haven't seen much movement when it comes to a deal.
Absolutely. It'll be fascinating to see how that shakes out. That is Bloomberg's Tyler Kendall with the latest on trade. But let's turn to equities right now, because clean energy stocks, like Matt highlighted, falling today after the president called for new rules that would cut access to incentives for solar and wind products. Joining us now is Bloomberg's energy and climate change reporter, Will Mathis. And Will, it's interesting to see these big drawdowns in some of these names, because we had a pretty good week in the sector last week, at least when it comes to their share performance. What exactly has changed?
Well, the Trump administration has clarified that there could be some additional restrictions on the eligibility for tax credits, which were already pared back by the big, beautiful bill. And, there was a bit of a jump last week, but that was kind of a jump based on avoiding the worst case scenario, that an earlier draft of the Senate bill looked really bleak for the sector, and what passed ended up being not as bad, but it's still much more negative than it was, this time last year before Trump came in.
Do you get any pushback from, we're going to talk a lot about Texas today. We have Ari Rastegar on, a real estate mogul out of Austin. And I think of Texas as the biggest state in the country for wind and solar. Are they getting any pushback from these, red states that also have huge business in renewables?
I think so far, Trump has been very effective at getting the Congress to line up behind him. What I think we'll see what that pushback will look like is when or if this starts to affect power prices, because, like renewables or not, they are quickest to build in many cases. It takes a long time to permit and develop a new power plant. If you want to build a new gas plant instead of a wind farm, it's going to take years to buy a turbine. And so if you have rising demand, like you're seeing, especially in a place like Texas, like you said, with AI demand and air conditioning demand with these hot summers, you need more supply. And if you don't get that supply that was going to come in, you're going to see prices go up. And if prices go up, that's when people, regardless of their political parties, start to complain.
All right, Will, thanks very much. Will Mathis there covers renewables for us at Bloomberg. Turning to the AI talent war in Silicon Valley, Apple's top executive in charge of artificial intelligence models is leaving for work at Meta. It's another setback in Apple's struggling AI efforts. Bloomberg Tech co-host Caroline Hyde joins us to explain. So, Caroline, we know that Mark Zuckerberg is paying tens of millions, if not $100 million to get the best AI minds in the country. Now he's taking from Apple, which already has issues.
It has issues. It has morale issues, particularly in the Apple Foundation model department, which the current exodus seems to be coming from. This isn't going to be the only executive. This is the leader at the moment. So Roming Pang led about 100 people in the Apple Foundation's models team. He's a distinguished engineer. If you're a key AI researcher, if you're a key engineer, where do you want to go? You want to go where they're paying you the big bucks, but they're spending the big bucks to win at superintelligence. That's where you want to take your talent. At the moment, you're looking at Apple and thinking, sorry, you're not even perhaps depending on the models that I'm building for you. You're looking outside to third parties like Anthropic or like OpenAI. Morale is pretty low. They've already lost some talent. This could just be the start of the marching that goes from Apple to places like Meta, which are spending and luring the top talent right now.
Well, you touched on what I've been wondering about, which is how this folds into the news of last week, that Apple is basically looking at outside AI to build that new version of Siri. And it makes sense to, I guess, pile that on to what we're seeing now when you talk about morale.
Yeah, there's peaks and troughs, right? So when you look back to WWDC, we did actually see a little glimmer of the fact that these foundational models that the Apple team have been working on, AFM team have been working on, did start to get opened up to third-party developers. You're going to build your apps on there. There was a feeling of enthusiasm for that. However, you then think, okay, what actually thus far does Apple Intelligence do that's built in-house? Maybe translates the odd text, maybe translates the odd email. But really, they depend on partners to do the bulk of image generation, image analysis, and therefore, even their coding, Xcode that was being opened up, that's dependent on Anthropic and other particular rivals. So what really is being done in-house isn't much. And no wonder we're therefore starting to see some of the top talent wanting to get paid more, because we know that Apple doesn't pay the most over there, and indeed wants to go to a team that feels full of enthusiasm to be on the winning side and join the likes of Alexander Wang from Scale AI, to join the likes of people who have founded GitHub and be that sort of source. So I think we could see not just one, but many start to leapfrog. And I think this is a tale of two halves. You want to go to a winning team, you want to go to where they're spending money. Mark Zuckerberg is having lunch with these people. He's inviting them over to Tahoe, his personal house. You're going to get an ego boost when back at home at Apple, your ego is really diminished and you're seeing some of the AI heads lose their control of their remit.
Right, if you're in this unit. I mean, I'm looking at the screen time on my iPhone, right?
Yeah.
I spend 4 hours and 46 minutes a day.
That's pretty good, actually.
On this phone. But if I look at the breakdown in apps, Bloomberg obviously the most, then Chrome, then ChatGPT. I mean, Apple doesn't necessarily need to be one of the apps I spend my time on, as long as I'm doing it on this device, right?
Precisely, and I think that's always been the argument. They don't need to spend gratuitous amounts of billions of dollars building their own large language models, paying up for data centers, if basically they can be the home for all these services. But then what does Apple become? Apple becomes a longer-term, revenue generator, but maybe not the innovator. And where do top talent want to work? Innovation hubs. And I think that's where the pull and the push is going to come. What ultimately is Apple going to become? Are they ultimately going to rely on third parties? They should make that decision sooner rather than later.
Absolutely. That's the question that investors are asking. I do want to briefly talk about Meta before we let you go. What exactly is superintelligence? What exactly are they trying to build with these acqui-hires that they're spending gobs and gobs of money on?
Well, they're the one key company that we now dub a hyperscaler in terms of they're building their own data centers, they're getting their own compute, that are able to really monetize. Basically, the ad services have become so much better, far more efficient. They're driving revenue. And I think Mark Zuckerberg is starting to realize that, okay, if we're going to go all in on AI, if it's going to be a winning formula for my company, I need to win at superintelligence. Whether or not, if you hear Sam Altman and some at Brad Lightcap talk about it, they don't really know why Mark wants to lead superintelligence, but many would just say you can't come second. If you're going to build the underlying technology that is as good as a human across the remit, whether it's coding, whether it's building advertising imagery, whether it's becoming a productivity hub. Look, we've seen what Facebook did in its prior iterations. It wanted to be the place where you brought work. It wanted to be the place where you were socializing, but also doing your enterprise.
Well, where you go, right? I'm going to the Bloomberg, I'm going to Chrome, I'm going to ChatGPT. I'm not going to Facebook, right? I'm not 75.
So, but what about
you
going to Instagram?
Yeah.
Exactly.
Because that's got, and what about Meta AI? Remember, they recently pulled out and have an individual app now, which is meant to rival ChatGPT. So I think Mark Zuckerberg's got his eye on a much bigger prize here that isn't just going to be your social networking and your advertising. It's going to be all things to all men when it comes to AI.
Well, I can't wait to see what exactly is built. Caroline, great roundup. As always, that is Bloomberg Tech's Caroline Hyde. You can catch her at 11 a.m. But let's take a look at this market right now. A little bit of a lift, but I stress a little bit, especially when you consider the drop that we saw in the S&P 500, in the Nasdaq 100 yesterday. Seeing this bounce back now as price targets are raised for the big index. Coming from Bank of America just in the past couple minutes, they just raised their price target to 6,300 for year end from 5,600. That follows that upgrade that we saw from Goldman Sachs this morning. The team led by David Kostin also bumping up their year end price target. So there's some optimism creeping into this market.
Yeah, no, I mean, we're already at all-time highs, so it's pretty optimistic now.
But when it comes to the sell-side community, it feels like it always takes a little bit of time to get on board.
Yeah, no, absolutely, and we're starting to see more. I think as you get the certainty of the big, beautiful bill, as we start to get certainty from tariffs.
Do we start to get certainty?
Eventually, you'll start to see more price targets raised. Coming up, Goldman Sachs, as Katie just mentioned, also boosted its S&P target, and Deutsche Bank calculates the tariff impact on earnings. Are tariffs going to eat into margins? We'll discuss all that and more with Emily Roland of Manulife, John Hancock. This is Open Interest. Let's get now to high interest. Look what's making headlines around the world. Amazon's Prime Day kicks off today. The retail event being impacted by President Trump's trade war as some brands opt out of the sale, and shoppers plan to pull back on spending because of tariffs. Prime Day lasts for 4 days, so it should really be called Prime Days. Robinhood CEO Vlad Tenev said the firm is in talks with regulators over its offering of tokenized equities in Europe. Last week, Robinhood announced retail investors using its app in the EU could start trading tokens that represent shares of U.S. equities on the blockchain. That move drew criticism from companies like OpenAI, which is weird. More than 100 people have been confirmed dead in floods that tore through central Texas over the weekend. The news marks a grim milestone as searchers use boats, dogs, and drones to locate victims. 10 children and 1 counselor from the Mystic Girls summer camp remain missing. We'll continue to update you with any developments on this tragic story.
Welcome back to Open Interest. There were some new strategy notes out this morning that show the impact that tariffs may have on coming quarters. You have Deutsche Bank strategists expecting tariffs to reduce earnings by 2 percentage points for second quarter S&P 500 earnings growth. Meanwhile, you have Goldman Sachs raising its 12-month target for the S&P 500 to 6,900. That would be a gain of 11% after factoring earlier and deeper Fed easing. Bloomberg's equities reporter JP Barnard has the details. And JP, I want to start with the Goldman note because, okay, they raised their target. This is the 4th time this year that Goldman has raised their S&P 500 target. And I think that really speaks to how when it comes to analysts, when it comes to investors, when it comes to news anchors, we're just trying to figure out the narrative here.
Yeah, absolutely. And that was a problem basically over the past 3 months because nobody really knew, like, okay, the wobbles of April, how are they going to affect the consumer, the corporate earnings, the corporate margins, the overall economy, what's going to happen. And I believe now at this point, we have a much clearer picture as that the consensus is building that we are going to see a little bit of an impact on corporate margins. And there is a consensus that the earnings season is probably not going to be as good as the previous ones, but it's not going to be like terrible. Then on the other hand, like your macro picture is still like pretty good. I mean, inflation is still all right. I mean, maybe it goes up a little bit when we get these tariff impacts, but not dramatically. The job market is still doing all right. And so there's a sense of that investors are willing to look through the short-term noise maybe, but that the overall picture remains one of being bullish and being healthy. Positioning is also not extended. The market is not like super rich, maybe a little bit hot in the rally. But I mean, like bottom line is there are a lot of reasons to be optimistic here right now. And so I believe many people who stayed cautious over the past 3 months don't have another choice than just like acknowledge that fact and reflect that in targets and estimates.
JP, how different does this market feel than early April? I mean, we thought tariffs were going to result in empty shelves and prices so high that consumers are facing starvation, like potentially world wars. And it looks not so bad, does it?
Yeah, absolutely. I believe like the narrative that we had for a very short term in April, where everybody was like, okay, we're going to get like a probably deep recession and a total breakup of global supply chains and global trade. That narrative lived up for just a couple of days, I would argue. And now we are in a much more moderate universe where we feel like, okay, the world is going to move on from tariffs. Okay, the overall tariff percentage will going to be higher, and that is going to be kind of a tax thing for everybody, but it's not something that is going to derail the overall economy. It's not going to derail the consumer at this point. And I mean, like, there's always a chance that Donald Trump is doing another step, and we saw this over the weekend, that headline risk is not fully fading at this point. But I believe everybody has understood now his tactics, his way of maneuvering through the whole thing, and that we are not getting this worst case scenario.
All right, JP, it certainly seems like that is the way the wind is blowing. Really appreciate your time. That is Bloomberg equities reporter JP Barnett. And let's keep this conversation going now with Manulife John Hancock co-chief investment strategist Emily Roland. Emily, it's great to have you with us. So we talked about the Goldman call. You also have Bank of America bumping up their price target as well. And I was just listening to Bloomberg Surveillance. You had Amanda Lyman on from BlackRock saying that there's a risk here of being too defensive. And I'm curious if you also see the fog clearing to such an extent.
We do, Katie. There's a lot of things going right today. You look at things from a technical perspective. Of course, we've got new all-time highs in the S&P 500. We've got sentiment that's gone from deeply negative to positive, but probably still has some room to run here. We've got a broadening out of market participation with financials and industrials getting in on the game. And then from a more fundamental perspective, the U.S. economy is doing fine. JP just talked about the labor market. The last few reads we've gotten on that, from initial claims to non-farm payrolls here, have been pretty solid. Corporate earnings growth, analysts are penciling in 5% this quarter. It might not be the 13% that we got last quarter, but still on solid footing there. Corporate default rates are low. We think really the only challenge here is that there's very little risk being priced into markets. That's probably the biggest risk right now. The S&P 500 is trading at 22.3 times forward earnings. That's close to the 10-year high. Corporate spreads are narrowing in on 268 basis points. That's incredibly tight, near 10-year tights. So we're just at a tough starting point for markets, but certainly a lot of things going right, but it is reflected in the price.
What about opportunity, Emily? I have a trader who always writes in about deregulation. Is that something that no one is really looking at?
Yeah, certainly. I think there's deregulatory moves going on in the background that are going to be accretive to corporate earnings. I think also the certain components of the big, beautiful bill, full expensing of CapEx, should result in an acceleration in CapEx spending. That's also going to be a positive for corporate earnings. So there are things going on that should definitely support corporate earnings. I don't want to paint the most amazing picture out there, because we have seen record profit growth, and we are starting to see some pressure on corporate margins as the cost of capital remains elevated and revenue growth starts to come down. So it's about identifying those companies that can do a better job.
Emily, we got to leave it there. We will be right back at the opening bell with Emily Roland. Don't go anywhere. This is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are doing not a lot on the S&P. We had a pretty decent sized drop yesterday, but from record highs. So we're in wait and see mode, a lot of traders will tell you, when it comes to tariffs. You can see the Nasdaq futures up 0.2, Russell futures up 4. So maybe more on the positive side. You hear the opening bell. At the New York Stock Exchange, you've got Core Civic ringing the opening bell. I think it's like they run prisons. So when Donald Trump was elected, the stock basically tripled, right, overnight. Down at the Nasdaq, Natera, NTRA, they're up 227% over the past 5 years. So they've had a pretty good run. In terms of the stocks that we're watching, Apple is front and center, but not really moving too much.
Not moving, but I promise it's interesting if you take a look at the details. We're watching Apple because it's lost its top AI modeling executive to Meta in a setback for Apple's AI ambitions, which has already seen plenty of setbacks. Remember that Meta has been on an acqui-hire spree to accomplish artificial super intelligence. Apple shares can't really decide what to do. They were down, now they're up, but we know that they've been a big underperformer so far in 2025.
Yeah, also watching in terms of stocks that are moving, renewable energy companies. You can see here Enphase is down 5%, Nextera down 2%, First Solar down 3%, after President Trump called for new rules that would restrict access to tax incentives for solar or wind projects that already had been pared back by his one big beautiful bill. All right, that's a roundup of some of the stocks we're watching. At the top, we're going to continue to bring you movers as this market gets trading. Right now, we're back with Manulife, John Hancock, co-chief investment strategist, Emily Roland. And Emily, we're kind of in wait and see mode when it comes to tariffs, right? We thought July 9th would be the deadline. Then we were told maybe August 1st, and Trump said that's not too firm. So how do you invest around this kind of uncertainty?
Yeah, Matt, we always try our best to minimize political and geopolitical inputs in our investment process because they're just so difficult to handicap here. It's really easy to have analysis paralysis if you're trying to digest all the news around the big, beautiful bill and around tariffs. What we're hoping here is that investors can move on to away from politics and towards profits. And we'll be able to do that next week with the start of earnings season with the big banks. It kind of reminds us of, I don't know if you remember that famous Bill Belichick interview about 10 years ago. They had lost to the Chiefs. He's in the press conference and he just keeps saying, we're on to Cincinnati. We're on to Cincinnati. We're on to Cincinnati. And that's kind of what we're thinking about as it relates to earnings season here, and analysts are penciling in 5% earnings growth for the S&P 500. We are looking at opportunities to see companies that can maintain margins in a more challenging environment here. Quality leadership coming back as we enter the back half of the year. Momentum and technicals have really sort of driven cross-asset leadership. And we think those high-quality stocks that can produce solid earnings results have the ability to see some price appreciation into earnings season.
So numbers aside, when it comes to the upcoming earnings season, we were having a great conversation with Lori Calvasina yesterday, and she made the point that we need to see more guidance. These companies have had 3 months to figure things out. And you think about the narrative from last earnings season, it was that basically companies didn't know what was going to happen. No one did. This time around, what are you expecting when it comes to the guides and the conversations that we'll get on earnings calls?
Yeah, I think there's still some, question about how tariffs are going to impact some of these companies. But you're right, it was amazing. Last earnings season, you saw companies giving 2 sets of guidance, scrapping guidance altogether. So hopefully we should have a little bit more of a robust set of information from corporate leaders this quarter. But what we're watching more specifically is just sort of how depressed, the returns have been in the United States versus Europe. So you look at analysts penciling in about negative 5% growth for MSCI EFA earnings. And meanwhile, they're looking at, mid-single digit returns in the U.S. European markets have far outpaced their U.S. counterparts, even with negative earnings growth. A lot of that has been driven by the weaker dollar. I think that's going to be another important conversation in the earnings season that's upcoming here about how currency dynamics have impacted profits. But we think that there can be a comeback here, given those better economic and relative earnings trends in the United States that have really been discounted versus European counterparts.
So do you sell Europe short and use that cash to buy the U.S.? I mean, what a pair trade.
I know we would be fading gains in some of those areas of the market. You look at things like European financials up 20+% this year, and their earnings have been negative 8%. To us, this has been a big shift in sentiment. It's sell everything America, whether it's stocks, whether it's dollars, whether it's bonds. We've seen huge capital flows into Europe. We still have international stocks in our recommendations, but it has been a relative underweight. I know that's very out of consensus now, but we're digging into that given better relative economic and earnings trends in the United States.
Absolutely. Nice to hear a contrarian there. I want to go back to something that I mentioned in the previous block, and that was that comment from Amanda Lynham over at BlackRock. She was talking specifically about credit, but she said there's a real risk here of being too defensive, that there's a risk of being too in love with those high-quality names. Again, that was in the context of fixed income, but do you think that you could apply that logic to the equity market as well, that maybe you should be looking at maybe more of those growthier companies right now?
Yeah, Katie, I listened to that interview. I thought it was great. And we do like growth. We've been overweight U.S. large cap growth stocks for years now. The challenge, of course, is the valuations. The S&P 500 growth index is trading at almost a 50% premium to its 20-year average. We're still there. Because we think that the earnings can deliver, but we have to protect against that valuation risk by owning some things that are on sale. We've been looking really closely at stocks that have superior return on equity, so great measure of shareholder profitability there, and marrying that with parts of the market that have solid PEG ratios. We can only talk about these things on Bloomberg, of course. Everybody's got their CFA textbooks out, right? So that's PE divided by earnings growth. It's a measure of how much you're paying for future earnings growth, because we we don't want to overpay. So it's bringing us to sector overweights in areas like technology and comm services, but also more defensive parts of the market like healthcare and utilities. It's really that intersection between quality and valuation, cheaper valuation, that's going to, I think, create the playbook that you want for the remainder of the year.
I look, Emily, at INGO all the time, the Bloomberg Index browser, and year-to-date returns are just down the line strong in fixed income, but especially in things like EM and high yield. Are those opportunities fading, or do you think there's still legs there?
Still legs, as long as default rates stay low and the economy stays on solid footing, which is what we're seeing right now, it's not much of a, we do think there's some opportunities there. The challenge, again, is the starting point where you're near 10-year tights on corporate credit. We've been neutral on the space because our view has been quite constructive on the economy and on the health of corporations here. But if you look to high quality bonds, they aren't kind of priced for perfection the way equities and credit are. In fact, we don't think bonds are sniffing out the disinflationary trends that we're seeing across housing and shelter, which is a key measure as it relates to inflation. There's so much myopic focus on the potential inflationary impact of tariffs on the good side of our economy, but we have to remember that that's a much smaller part of our economy. In fact, services is much more significant, shelter and housing being the biggest component of services. And there's a lot of things changing on the housing front. Supply is coming online. We have the most supply since 2020. Demand is slowing in the face of unaffordability and untenable insurance costs. So home prices are actually starting to roll over, that we think has a massive influence on disinflation and potentially the ability to counteract any potential goods inflation. The bond market's not sniffing that out. Yields are still elevated. We would take advantage of those elevated yields, lock in income for clients, get that cash off the sidelines, and create an income stream that can last for years.
Yeah, encouraging people to move out of cash. It's been a difficult climb to get them to do that. Yeah. Emily, it's great to speak with you. Hope to do it again soon. That is Manulife John Hancock's Emily Roland. Let's get a check on this broader equity market right now. You can see we're just about unchanged when it comes to the S&P 500. We're still pretty dang close to all-time highs when it comes to your big benchmark, even with that decline that we saw yesterday. When it comes to the split of how the single stocks are doing right now, it's almost even. You have 268 names in the green, 232 in the red right now. You look at what's leading, you have a lot of big tech up here. NVIDIA, Oracle, Broadcom, Tesla, Meta, the list goes on. For some of these names, this is just a bounce back from what we saw yesterday, but still a positive contribution. But then you look at what isn't doing too hot. Apple, actually, those losses accelerating right now. We know that they lost one of their key executives in AI to Meta. Shares down about 0.7%. JP Morgan also a sizable bump down there, almost 2%. This is what you're going to see on the sector level as well. Because you do have that bounce back in some of the big names, you have energy, healthcare, materials, and then tech up at the top. On a points basis, that's actually your biggest contributor right now, which probably speaks to how contained this movement is in the benchmark. But then you go to the bottom, you have financials, consumer staples, and utilities down at the bottom by 1.4%. We know that this has been one of the hotspots of this market, Matt Miller.
Yeah, very interesting to see consumer staples and utilities down there at the bottom, healthcare and materials up at the top. So those defensive sectors kind of split. That's what I obviously always look for. Coming up, we're going to talk about Apple losing its top AI model engineer to Meta in a potential setback for the iPhone maker's push into artificial intelligence. But is it really, if Apple has decided on partnerships as the way forward? We'll talk to Mandeep Singh about that next. This is Open Interest.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Datadog is getting downgraded to a sell over at Guggenheim as OpenAI, which is Datadog's largest customer, starts to build its own monitoring system. That's good for a 4.3% decline. Next up, we have Wall Street weighing in on CoreWeave's all-stock acquisition of Core Scientific. and it's not positive. Both Stifel and Mizuho are downgrading the stock, citing near-term overhangs. It's still up almost 300% since its IPO, but down about 2.5% today. And finally, we have Capital One getting upgraded to a buy over at TD Cowen. The firm sees upside after its purchase of Discover and sees potential for significant buybacks in the future, Matt.
All right, so buy there for Capital One. Let's get to Apple. The top executive there in charge of artificial intelligence models is no longer working for Apple. He's leaving for Meta. It's another setback in Apple's struggling AI efforts, or is it? Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, is here. Mandeep, I've been struggling with this all day because I use this device constantly, right? Or my iPad or my Mac at home. But I don't use any Apple apps on those things, except for messages and music, right? I'm using Google's Chrome. I'm using Bloomberg. I'm using ChatGPT. So why does it matter if the top AI guy left, since they're going to use those other partners anyway to generate revenue?
So, I mean, when I look at Apple, traditionally they have developed their own ecosystem, whether it's their operating system, their own chips. They've optimized for performance. And you're right, for certain cases, apps, from Google serve better when it comes to traditional search.
They don't go into search, right?
Absolutely. But with that being said, I think AI is that sort of technology that it will impact them in terms of, providing a better voice assistant when it comes to Siri, or even, scheduling the calendar. So Apple does have a calendar app. Well, what about scheduling the calendar through the AI that's on the phone? And that's where, having an AI play does matter. I mean, you talked about ChatGPT. The usage of ChatGPT app is growing to almost 30 minutes per daily active user.
I use it 54 minutes a day.
So just this entire hour.
And imagine if that type of AI was on the phone, where you could trust the AI, was focused on, protecting your data, it didn't really offload it to cloud, then you will end up using it. So it is about the future, and that's what everyone is betting on. I mean, to me, both Meta and Apple are lagging behind in AI. But what Meta has done is really gone big in the last couple of months in terms of acquiring talent and paying up. And you can only do it when you're a founder-led company with all the voting rights that you don't care. You just want the top 50 researchers on your platform.
Well, why doesn't Apple pay up? Apple has a famous amount of cash on hand. They have so much money. Why don't they just go out and buy something if they're so behind in AI?
Well, so it's about capital allocation, and what Apple has done traditionally is, out of the $100+ billion in free cash flow they generate every year, they buy back their stock. They have done a lot of acquisitions, but those are more tuck-ins. They've always been about getting people, and that's what I think Meta is preempting here, is they're going big in making sure the top 50 AI researchers are working for Meta, and they're really bidding up. I mean, when I look at, acquisitions, CoreWeave paying $9 billion, that's almost, 30 million per employee, because the company they bought is a 300 people company.
Yeah.
So from that perspective, right now we are in an environment where AI researchers are really getting bid up, and it shows up.
When it comes to Apple, I mean, they're also extremely conservative when it comes to M&A. I was reading a Mark Gurman piece that pointed out that their biggest ever purchase was Beats in 2014. That was $3 billion. And in their entire history, they've only made 3 transactions more than $1 billion.
Yeah, it's a great point. They just don't spend. They have a ton of cash. They don't spend it on acquisitions. I was given an article by Mac Rumors on the iPhone 17. It's rumored to... It's rumored to be coming out in a different color than you've ever seen before. And I'm wondering if is that what they hope is going to drive the next iPhone purchase cycle, blue?
At the WWDC, they showed the liquid glass display, so that's a big change in the look and feel. But
yeah,
look,
but not enough to make me buy a new phone, right?
And that's where the AI element comes into play as well. So look, AI will still be predominantly on the cloud. I think on-device AI hasn't really taken off just because of the size of these models. They require a lot of memory. So you can't, load up a large language model on your phone. You need a distilled version. And that's where there are challenges in terms of doing things on device. But Apple still owns the distribution. When it comes to the ecosystem they have, whether it's through partnerships or their own AI efforts, they will figure out a way. It's very easy to think, oh, they're losing traction. They're just prudent about how they go about things. But clearly, they have underinvested in AI, and they'll have to fix it either through acquisitions or some big alliance, whether it's with OpenAI or Anthropic or Google. They just have to find that way.
Well, for those keeping track at home, Apple shares now down about 16% year to date. Mandeep Singh of Bloomberg Intelligence.
Still a $3.1 trillion company.
Yeah,
it's still
really
worth almost
big.
twice as much as Facebook.
They're really big and they have a lot of money, and maybe they should spend some of it, buy a company and get ahead in AI. That would be something. Coming up, one winner from President Trump's tax law, SoFi. Details next on how the private student lenders may benefit. This is Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks right now. In the horseshoe, you can see the green chiclets dropping. Not huge gains, but the S&P 500 clawing back a little bit of what it lost yesterday. Right now at 62.36, still a relatively high level. Take a look at some of the stocks that are moving. The big kahuna is Apple. As I said, it's worth $3.1 trillion, a little more than that, even with today's drop, which is only 0.4%. Facebook climbing about 0.2%. So not big moves in terms of the mega cap stocks. You do have SoFi moving up 6.7%, and we're going to focus in on a SoFi story, Katie, right now.
Yeah, let's do that, because we've talked a lot about the companies that would be negatively hit from the tax package, but let's focus on one industry that could benefit: private student loans lenders, and SoFi in particular. Joining us to explain now is Bloomberg's consumer finance reporter, Paige Smith. So, Paige, you take a look at shares of SoFi. They've been on an absolute tear, currently trading at their highest level since 2021. What is the calculus here?
So Trump's big tax package has now been signed into law. So I think that it would really give private student lenders a boost, because if you think about it, students are still going to need to borrow for college. And this package limited the amount that some grad students and their parents can borrow to give, those students the opportunity to get some higher education. So it's not like those students are going to just stop going to school. They're going to theoretically look for other options. And that's where we see analysts coming in and saying theoretically that SoFi would be the company that would benefit.
The most, right?
The most, yes.
And it's going to be a little bit more costly, right? Obviously, SoFi is going to charge a little more than you would get with a FWSB, which is the Federal Work Study Program.
FWSB, yeah, got that.
Remember that? So these students are going to have to pay up.
It depends. I think there are a number of different options, of course, but yes, I think that it would be fair to say that sort of federal student lending programs were kind of the gold standard for students who were looking for higher education loans. But, it's important to remember that SoFi has been in this space for quite a long time. This is kind of where they got their start, and they know the area very well. So they have actually been sort of moving away from student lending and some of the loan-based business. It's not like they've abandoned those businesses. It's just that the company has put more of an emphasis on fee-based revenues. So, but theoretically, if there's this opportunity to be seized, Anthony Noto, the CEO, said on the previous earnings call that they would essentially go after the opportunity.
You know what? When we were kids, some parents would put college tuition on credit cards. Because you could get so many points. But I don't think they allow you to do that anymore, do they?
That's a good question, but that would be a pretty costly student loan. I'll leave it at that. I don't know if it's worth the Amex points.
Paige Smith covers consumer stuff for us here at Bloomberg. Coming up in the next hour, Hamilton Lane co-CEO Erik Hirsch on tariffs and the big, beautiful bill. Plus, we talk to the Oracle of Austin, Ari Rastegar, on real estate in Texas and nationwide. This is Bloomberg. We are 30 minutes into the trading day, looking at some slight gains. Well, no, we were for a moment. The Nasdaq is still up 0.04%.
But the S&P 500 on tender hooks amid these trade discussions.
Tenterhooks, I think.
Tenterhooks.
Is it tender?
Oh, I don't know.
I think it's tenterhooks.
I always get this wrong. 15 degrees off every time.
Double check. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak, and we are looking at the trade talks float into the markets. I'm looking at that 10-year yield float above 4.4%, and we are looking at President Trump open for talks. He sends a wave of threatening letters to trading partners as he delays the tariff deadline.
Meet the Oracle of Austin. Real estate developer Ari Rastegar joins us on the state of real estate in Texas and across the country, as well as his efforts to bring big banks to Dallas.
A lot of them are going there, and a lot of them are also going to look more at cryptocurrency. We're building the digital reserve of the future. We're going to bring in Jamie Leverton, former CEO of Hut 8. She is taking her new firm public in $1 billion SPAC deal, and she joins Open Interest later this hour.
President Trump sent letters to 14 countries yesterday outlining higher tariffs that they'll face if they don't make trade deals with the U.S. by August 1st. He said he's still open, though, to negotiations.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
For more, we're joined by Bloomberg Washington correspondent Tyler Kendall. So, Tyler, we now have, the goalpost pushed back and essentially widened a bit, right? There's room for negotiation, and the deadline is soft.
Yeah. Hey, Matt. Room for negotiation. You heard President Trump there saying that August 1st is firm, but not 100% firm. Signaling on openness here to keep talks going, and that also some of these updated tariff rates might ultimately change at the end of the day. And it was interesting to see which countries received these letters, because it's our understanding that these are the ones at the moment that the U.S. is most frustrated with when it comes to the trade talks. We had the Treasury Secretary Scott Bessent saying that their playbook here is maximum pressure. They're trying to get these trading partners to put their best offer on the table. But look at the ones that we did see, like Japan and South Korea, two countries that have long been prioritized in these talks, but have appeared to hit some roadblocks. And our reporting indicates that that's really over some of those sector-specific tariffs, like autos and steel and aluminum, really Section 232 tariffs that weren't supposed to be part of these negotiations to begin with. Now, the White House Press Secretary Caroline Leavitt did say yesterday that more tariff letters could be coming in the mail. Bloomberg Economics estimates that of those trading partners that did receive a letter so far this week, they account for about 15% of U.S. imports. Matt and Sonali, two threads to kind of watch in the days ahead. One is any sort of retaliation. President Trump made absolutely clear that if any of these trading partners do retaliate, he'll slap an identical tariff on top of the rate listed in that letter. And the second is whether or not we could get any updates on positive momentum when it comes to trade deals. People familiar do tell Bloomberg News that the U.S. appears to be on the cusp of some sort of agreement when it comes to India, Taiwan, and the European Union. But the idea of a breakthrough before the original July 9th deadline, according to people familiar, is a little too far-fetched. It appears that they might need a little bit extra time to ultimately make that announcement.
Tyler, we thank you so much for keeping an eye on all of it for us. That is Bloomberg's Tyler Kendall. We're now going to bring in Erik Hirsch. He's the Hamilton Lane co-CEO. And Erik, you look at this new kind of deadline of August 1st. August is a month that most people like to go away on Wall Street. This seems to be a summer that is going to have a lot of prolonged uncertainty, and I'm wondering how your clients, how investors, how other firms that you work with in the fund management industry are dealing with that prolonged uncertainty.
Sonali, great to be back. Good to see you. I think we're in for a choppy summer. I think no one's going to get the free break that they were hoping for in August. There's going to be a lot of negotiations. There's going to be, I think, a lot of deals struck. And we continue to see this administration use these tariffs as tactics and as tools. And that does not appear to be changing.
What do you think about, the impact of tariffs? We expected it to be pretty horrendous at the beginning of April. And now it seems like something that our trading partners and U.S. consumers can live with. Are you reading it the same way?
I am, Matt. I think the administration is telling us two things. They want to get trade rebalanced in a way that they perceive to be more fair and equitable, And at the same time, they are very conscious of not harming the markets. They're clearly keeping an eye on what's happening in the markets, and they're adjusting posture as needed to make sure that the markets remain strong.
When we think across markets, outside of even traditional way equity markets, the bond market in particular has been so interesting. Just a day ago, Matt and I were sitting here saying at 4.3% on the 10-year, there's really nothing to cry about. But then we drift today back to 4.4%. We are off the highs of this year, Erik. But at 4.4%, you don't see the Treasury Secretary calling victory here in the bond market. How is that 4.4% feeding through across private credit, fixed income managers, people who really find difficulty navigating through elevated interest rates?
So this is an interesting thing. I think you're seeing a bit of a disconnect right now between the equity markets and the bond markets. So I think that sort of continues to bear watching. Now, the rising rate environment is still not causing a slowdown on private credit. In fact, in some levels, it's continuing to accelerate because what you're seeing is not so much a huge move by institutions into private credit. They've already been there. But it's really the individual investor that's beginning to pivot more aggressively, taking advantage of what the private markets are offering. They have not had exposure to that to date, and they're beginning to make that big change significantly right now.
Erik, I have a trader friend that I talk to all the time. We do the back and forth on Trump did this and Trump did that. And he's always saying, look, deregulation is going to be an opportunity. This is going to benefit the U.S. economy, a tailwind. And I'm trying to suss out what the actual deregulation opportunities are going to be. What's your take on that?
I think historically you've seen deregulation benefit larger corporations as they just continue to expand more rapidly. I think the thing that we're looking at more closely is the amount of capital that's going to be plowed back into the U.S. economy as we're continuing to make a huge effort here to reshore. So to me, the tariffs are really about two things. It's about sort of that equitable redistribution that we talked about earlier. But more important, the administration is telling us very clearly they want to put manufacturing of certain goods and services back in this country, and that's going to take real infrastructure spend to do that. So there's a job creation element, but there's also power needs, hardcore infrastructure, building, et cetera. So all of that, to me, is also big capital flows back into the country that we also need to keep an eye on.
Can I ask about then specifically private markets, because you have a specialization there, and we've seen incredible growth, right? Sonali's been covering this like crazy. Is that going to continue? Does that have legs? Does a lot of this capital flow into private markets and not necessarily all into publics?
I think the private market is really becoming a little bit more bifurcated right now. So institutional flows into private markets are actually slowing. So the institutional investor generally at exposure, waiting for more liquidity to come out of the system. And so we're not seeing record institutional fundraising. Where we are seeing record flows is more back to that retail investor. So as the industry is opening up to that individual investor, their flows are significant. But I think it's important to recognize that those flows are being captured by a very, very small number of managers. There's really just a tiny subset of very large firms, including firms like Hamilton Lane and others, that are really benefiting from that. But that's not enjoyed sort of success by the entirety of the industry. And so those flows are being captured by a very small number of players. But those flows are significant, in some cases offsetting where you're seeing the weakening from the institutional side. And I don't expect to see that slowing. That is continuing to accelerate.
Erik, with more retail investors looking to private markets for an opportunity, my major question is, what does the ugly look like right now? Because there is a lot of bifurcation, as you say. There's a lot of dispersion in returns, and there are corners of the market that are clearly showing cracks. So what's the advice there for people to avoid the damage?
I don't think this is new, Sonali. I think you've covered this for a long time. Our industry, despite maturing and growing and doing all the things that it's been doing, has continued to have a very, very wide gap of performance. So the pundits have been telling us for years that as our industry grows and matures, et cetera, that compression of returns will happen and will happen significantly. That has been wrong. The compression has not happened. The dispersion continues to be very wide. Great managers are still generating great performance, and bad managers are still generating really bad performance. That's not changing. It's why sort of buyer beware is very much sort of the mode of the day here of making sure that you are choosing and selecting carefully, because if you're right, you're right, and if you're wrong, you're very wrong. And that's why firms like ours continue to exist, because there's a skill set and a history of doing that successfully.
Eric, we love to get your intel. Thank you so much for sharing your time with us. Erik Hirsch there of Hamilton Lane. And I want to just say, you know, we sit next to each other. So when you come in the morning, you kind of download what you're concerned about, your worries. And I think it's so great that you named your show Bullish, because you're actually so, I don't think bearish is the right word, but you're
cautious.
So cautious. Exactly. So
That's
good
true.
on you for taking that step with the brand Bullish, because it projects a much more optimistic Sonali Basak.
When it's raining at night, me and my dog are both hiding under the couch, unfortunately. So a lot of fear under the surface, but not today. Let's get a look at some of the single stocks moving this hour. We're going to bring in Bloomberg Equities reporter Nora Melinda to talk about some other places where you see very bullish CEOs sometimes.
Sometimes, right. Well, we're looking at shares of Tesla this morning. They're up about 1% right now as we speak. They're pushing the Mag 7 stocks higher. And of course, we know this is a rebound from what we saw yesterday. We saw shares that were slumping more than 6%. And that's after, of course, we know Musk said that he was interested in creating a new political party called the America Party. And of course, a lot of investors were nervous about the fact that this could spur backlash toward Musk, and of course this will be a hamper toward his company and a lot of the companies. A big distraction, and that's what a lot of these analysts are talking about. We had Wedbush saying, while we're seeing a bit of a rebound today, the stock is down 27% when we look at a year-to-date basis, and they're saying that they feel as though the board needs to step in, and this is a tipping point for Tesla in terms of what the stock will do moving forward. But I'm also looking at clean energy stocks. They are in the red this morning, also known as renewables. And they're falling after Trump called for new rules that would restrict access for tax incentives for wind and solar projects. Of course, we know some of these accesses have already kind of been scaled back in Trump's recent bill for $3.4 trillion budget bill. But we see JP Morgan saying that Vestas is one of those stocks that could have the most exposure here as we're looking at the stock. But last but not least, I am looking at Capital One. Those shares are higher this morning. And this is because they got an upgrade at TD Cowen. They raised it to buy from hold because they're saying that its purchase of Discover should be a tailwind for the stock. They're saying that it could also open up a significant potential buyback opportunity for the company moving forward. And of course, for Discover specifically, they think that it could potentially give it more international exposure. So we're seeing shares of Capital One getting a pop this morning.
And 1 week from now, big bank earnings start. We'll get
Right.
a sense of whether people are borrowing, whether that credit card money is
Up your
coming in.
alley.
Totally. We're looking forward to it. Nora, thank you so much. That is Nora Melinda, of course, of Bloomberg News. And as Matt was saying, tonight on Bloomberg, catch the latest episode of my show Bullish at 6 p.m. Eastern on Bloomberg Television, or stream it at 8 p.m. on Bloomberg Originals. We have crossed 1 million viewers. We hope you like it. Here's a sneak peek featuring Ann Walsh of Guggenheim on women shaking up Wall Street.
Well, you know, it really is something I'm passionate about, is trying to attract women to the industry. We see movies like Wolf of Wall Street, you know, and Greed is Good, and that's just not really very attractive to women and also young people today. They want purposeful careers. They want to know that they're making a difference. And in my view, investment management and asset management are making a difference. We're the caretakers for people's retirement money, or the savings for their kids to go to college.
Let's get now to high interest. Look what's making headlines around the world. The Transportation Security Administration, the TSA, is planning to update its policies to allow U.S. travelers to keep their shoes on through airport security checkpoints. The change will likely speed up screening for airline passengers, but is no good for me because I always wear boots that have metal stakes through them. Daimler cut its sales and profit guidance 2 months ago thanks to trade uncertainty. This is Daimler Truck, by the way, not Mercedes-Benz cars. I spoke with Daimler Truck North America President and CEO John O'Leary earlier to get an update on his outlook.
There really needs to be, I think, a firming up of economic policy before people understand or realize this is what we have to work forward with, and then we can all adjust and move. But in the meantime, the uncertainty just has people frozen.
And more than 100 people have been confirmed dead in floods that tore through central Texas over the weekend. The news marks a grim milestone as searchers used boats, dogs, and drones to locate victims. 10 children and 1 counselor from Mystic Girls Summer Camp are still missing. We want to get the latest developments in this tragic story now. We're joined by Bloomberg's Texas Bureau Chief Julie Fine, who joins us from Dallas. Julie, Governor Abbott is expected to hold a press briefing today. What do you want to hear from that?
Well, I expect him really to discuss the search efforts. I think he'll go through if there's any new information, but I think he will face many questions about what is going to happen next. The Texas legislature does meet again this month in a special session. I expect he will discuss whether he will add to the agenda more funding to help emergency systems, possibly add sirens on lakes. The lieutenant governor yesterday said that is something that they will do and the state will pay for. I think he will face questions about that today.
What do we know, Julie, about the latest on the ground from the search efforts?
Well, we know, sadly, that the numbers went up this morning. More than 100 people are now confirmed dead in this. We also know that there are still many missing at this point. We've got volunteers from throughout the nation here, federal, local, state, working together in this effort. Nobody has come out and said yet, okay, we're fully now in search and recovery. But during the last few days, as you know, with these tragedies, the longer the time goes, the more people begin to realize that is what may be ahead.
All right, Julie, thanks very much. Julie Fine there is our Texas Bureau Chief reporting live from Dallas, and we'll continue to bring you developments as we get them. This is Open Interest.
Now, finance is an industry long been dominated by men, but women are rising and they are controlling more wealth globally. How did the women of Wall Street break through? And what's changing now that they have? On the latest episode of my Bloomberg original show, Bullish, I sat down with Citigroup CEO Jane Fraser.
Citigroup at this juncture moves $4 trillion a day. $5 trillion. That's larger
We're
than...
growing.
It's larger than the GDP of France that you move daily. What kind of weight do you feel on your shoulders in the morning?
I think the same as any CEO. You have to wake up every morning somewhat paranoid, feeling that urgency, a bit of excitement about what you need to do, but I think a healthy amount of pressure.
I feel like I've really tried, and as long as I've known you, to not ask you about what it's like to be a woman. I've very intentionally tried to not make that a part of the conversation, but I feel like it's now come the time to ask. Why is this something that is not addressed more loudly in this industry, that there's only one woman to lead a major U.S. bank?
It is a little surprising. I think there is a good generation coming through of really super talented women. But we've also got to recognize that there are some biases in the system, unconscious or conscious, and it's important that there's more of us that are breaking through and getting this into being business as usual rather than business unusual.
Does it ever feel frustrating to you to have to be vocal about the issue or to be the face of the issue? No one ever asked David Solomon about what it's like to be a man.
It gets frustrating when someone asks you about certain questions they wouldn't ask a guy, but for us it's about how do we try and provide opportunities for everybody along the way, make it a win-win, because I think we're dead in the water if it's a zero-sum game. If we weren't competing for the best female talent, I would be cutting the bank off from 50% of the workforce and really putting us at a competitive disadvantage. Diversity is harder work, but it more than pays for itself. My frustration is when people don't believe in the business case because it's so blindingly obvious to me.
And that was Citigroup CEO Jane Fraser. And you can catch the latest episode of Bullish tonight at 6 p.m. Eastern on Bloomberg Television and 8 p.m. on Bloomberg Originals. Let's get a check on the market right now because it has been a choppy trade. You're looking at the S&P 500 now negative on the morning, and you're looking at a very mixed bag when you look at sectors and also specific stocks. For example, Tesla back on the rebound after a drawdown yesterday, but Nvidia still the largest points gainer today. Again, this week has been choppy, but you do not see the same out of big tech. On a points basis, JP Morgan is the largest points drag on the index today. Microsoft, Alphabet, Amazon close to it. Bank of America also feeling that drawdown. Remember, yields today are on the rise. Let's take a look also here at what the sectors are doing. As I've been saying, it's a mixed trade. You do see energy on the rebound today, about 1.5% higher as an industry. Those traditional oil giants on the rise. Just a day ago, you actually saw utilities really leading just yesterday. On the bottom side today, down about 1.8%. But remember, this has been a very popular trade. Picks and shovels. Consumer staples also. Yesterday was the biggest trade. Today, the defensive trades are the ones on the decline. Healthcare still up. Information technology still up, but barely. Materials still up. I've got to say, if you looked at this about a half an hour ago, there was a bigger bid in the market. Remember, real estate with yields on the rise, you are still seeing a bit of a drawdown in real estate. Consumer discretionary, that is where Tesla is, but you are still seeing 0.3% lower. Now, we'll take a look at how the days goes. Volatility is still low. Earnings still en route in the next couple of days. But coming up next, we're going to talk more about Texas. It's continuing to attract more investment. Jobs are changing, and they're moving across the country. Real estate investor, developer Ari Rastegar joins us next on the state's growth plans and that big, beautiful bill. This is Bloomberg Open Interest.
Texas is the place in America where people want to go to do business. And it's been the vision of Governor Abbott to make sure that not only is Texas the best venue to start a business, but to headquarter a business and now to incorporate a business and go public, trade, issue, all in Texas.
That was Jeb Penteling, Texas Stock Exchange strategic advisor, of course, former chairman of the House Financial Services Committee, speaking to Bloomberg last month. He is part of a group that is set to launch the Texas Stock Exchange and really bring the financial world down to the Lone Star State. Ari Rastegar, Rastegar Property and Rastegar Capital CEO, is also involved in that group and investing and has been heavily in Texas for 20 years now. First in Austin, now he's working to bring several big banks down to Dallas, and Ari joins us now on set. Ari, great to have you here. I've been looking forward to this for a long time because you have kind of a legendary real estate investing career. You started, I think, less than 20 years ago buying single-family homes when you were in law school, and now you've got a verified empire across dozens of cities and states. How did you do that?
I'm not entirely sure, but I do take a key from the Nike, kind of just do it. And I think if I look back, it wouldn't have turned out this well. But I think there was a lot of luck involved as well, to be perfectly clear.
Well, and rates, right? Because you have, it strikes me during that period, a lot of zero interest rate time. Obviously, that's not what you're paying on capital, but would it be more difficult now in this environment?
100%. And so, when I was starting out building little single-family homes north of San Antonio, you get a loan at a little over, 3.5% interest only on construction. That makes a big difference. And when you have rates that are so low for too long, arguably, and raised too fast, too high, you end up having a little bit of a problem, which I think is fueling some of the other problems, especially some you're having here in your home city.
Are you alluding to the pricing problems?
I am. It's a pricing problem, but it's also a systemic problem. Right now, real estate is about people, right? So right now we're in a transition phase and a reestablishing of the leveling of real estate in general. We're seeing it in office. We're seeing rates stabilize, cap rates, et cetera. And when you start having bigger geopolitical issues that come into the finance of business, you start to have other problems that you need to work through.
I want to go back a little bit. You know, Matt was telling me a lot about your involvement in bringing more of the financial industry down to Dallas.
Yeah.
I've been spending a lot of time watching Dallas as well because it's one of Goldman Sachs' biggest offices already. Now, if you were a betting man, what do you think happens? When do you think Dallas could actually be a bigger office than New York City for Goldman Sachs? Do you think that's happening?
I think it's the right question. And certainly what it means is this is the decentralization or the beginning of the decentralization of this kind of monopoly New York has had on capital markets. All money has to, come through New York at the end of the day. And I think this move from Chicago into Texas is making a big discussion. But Goldman has been in Dallas, since the late 60s. JP Morgan is one of their largest offices. And so, but this particular moment is symbolic as well as it is systemic. Because with 5,000 in-office employees right there in the center of what we've dubbed now Y'all Street, that sheer gravity of people alone and the ability to go public on the stock exchange, clearly Texas has shown, its resilience and its business-friendly capabilities, I think more so than any state in the United States. I'm not biased, clearly. But now to be able to actually go public and access the global markets, now you're talking about something that's truly once in a generation.
Does this push... Well, if we get Zoran Mamdani as the mayor here, right, and it's a pretty good chance since he won the Democratic nomination, does that push more of Wall Street towards Texas, or do they continue to flow as they did during the de Blasio years and, Trump's SALT cap to West Palm?
I think without a doubt, the greatest winner in that election, if it comes to pass, as you said, is Florida. Second is Texas. Because the frustration levels are already high, stress levels are already high from a variety of different areas. You've seen some big real estate owners in town, obviously, be speaking about this, but the free market nature and the capitalistic nature of what makes New York like this beacon for the world, when you start to stifle that light and dim that light, it creates a problem much bigger than simply trying to increase property taxes and freeze rents. This is a very, very slippery slope for what I would argue is the greatest city in the world.
It's interesting. You're talking about the Texas versus Florida kind of competition, if you will, as you watch people potentially move out of New York. What does it mean in terms of what you want to do in terms of your future investments? Now, it's very noticeable that rents in Austin have been cooling. There has been a really glut of supply, if you will. Do you look elsewhere?
We do. I mean, we've invested in 38 cities and 13 states over the years and honed in on Texas because we know it. If you look at the sheer population growth of Texas, the I-35 corridor, which basically connects Dallas all the way down to the Texas-Mexican border, the transits that go on this are so tremendous that we could invest $100 billion just in that corridor, and it wouldn't even be, a drop in the ocean. So for us, really focusing on the areas where the Teslas of the world are getting pretty cozy, the Oracles of the world are getting cozy, Chevron has been there for a long time. You have 1 out of every 10 Fortune 500 company in the world based in Texas. We think in a place that we know, a place that we understand, a place that we live, a place that we're raising our children, it can be a place that we can not only help build and guide the growth, but also be a participant in the enjoyment of being there.
But at the top of this interview, you mentioned luck played a part in your success. I mean, you've grown this massive empire out of a place that wasn't as hot when you started as it is now, right? Austin just was booming right when you started to invest in it. What's the next Austin? What's the next huge opportunity as you look across all of the cities in your portfolio?
I think it's really the elephant in the room. I think Dallas clearly leads that pack for so many different reasons. I mean, the stock exchange coming by itself, and I think it's been spoken about in a way that really hasn't magnified the importance of the most capitalized public stock exchange in the history of the world coming into Dallas, backed by the BlackRocks of the world, the Citadels of the world. That piece alone, I think we'll look back in 20 years and say, this was so obvious that Dallas was going to become one of the epicenters of the world.
And it's ironic because of Liar's Poker, right? Yeah. At that time, equities in Dallas was not what you wanted to be doing.
Right. Maybe things will change or can continue to change. Now, I do want to switch gears here and ask about the very serious matter that has been going on in Texas as well. The deaths have exceeded 100. Catastrophe in the state with the flooding. How do you feel that the state is handling the issue?
I think Governor Abbott has just proved to be tremendous in so many. And we actually saw, the Pope himself say some very beautiful words for the victims in the flood. I think when something like that happens so quickly, we almost have a little bit of paralysis, as we should as humans when things like this happen that are so catastrophic. They're difficult to wrap your heads around. I mean, our hearts, our prayers go out to all the families. In fact, one of our dear friends, from high school lost her daughter, and so I think the tensions are still starting to level. But I can tell you that it speaks to an issue where these types of floods that are happening, for whatever reasoning people believe, I think it does speak to a point where we need to be having deeper discussions about infrastructure. We need to be having deeper discussions about emergency response times, and that might not be the moment now, but I was pleasantly surprised at how human the response was from the Texas government, the legislators, the police and firefighters that really put their lives at risk very quickly and very instinctually, which really shows you how much how much love and compassion they're bringing.
Well, Ari, our condolences to your friends and everybody in Texas who's suffered from this, and we really appreciate also you coming up to New York to talk with us. Hope to have you back on soon. Ari Rastegar there of Rastegar Capital and Rastegar Property. I want to get a check right now on what's going on in the markets. We continue to see little change on the S&P 500, but at relatively high levels. We fell off of all-time highs yesterday with a drop, but still at 62.36 on the S&P 500, and we've seen strategists, including David Kostin's team at Goldman Sachs, raised their forecasts for the S&P 500 to 6,900, the 12-month forecast. So still a long way out from the 62.36 that we're looking at now.
Certainly a big moving target. There is a stock that I want to point out really quickly as well here, FICO. Shares are falling because FHFA Director Bill Pulte says Fannie Mae and Freddie Mac will allow lenders to use the Vantage 4.0 credit score to increase competition in the credit score ecosystem. Of course, Vantage 4.0 is a competitor to Fair Isaac. Fair Isaac now down 5.5%. Bringing the year-to-date losses to almost 12%. Pulte has been quite critical of FICO scoring throughout the course of the year. But we're going to now switch gears, look at other stocks on the move. We're going to bring back equities reporter for Bloomberg, Nora Melinda. What are you looking at?
Well, there's a couple of stocks that I've got my eyes on, some of them in your patch. I'm looking at a name in the red, Bank of America. It's one of a few of those bigger banking stocks that are in the red this morning after they've been getting some downgrades from HSBC. HSBC is saying that they see downside risks that are not currently factored into stock prices. As you flicked at earlier, we have earnings season coming up next week. So this is really interesting, especially if we've been looking at a lot of these banking stocks flirting with a potential all-time high. So we really do have Wall Street a bit divided right now, while some analysts are saying that they do see more growth for the banking stocks, and others saying that a lot of these macro uncertainties and potential interest rate cuts could potentially be headwinds for the sector. But I'm also looking at shares of CoreWeave. We've seen a couple IPOs this year, and that is certainly one of them. We're seeing shares that are down after the stock was cut to neutral at Stifel and Mizuho. So we really are seeing the street starting to pull back a little bit on this company. This is after we got that news earlier on about the fact that they were going to be doing some M&A, purchasing Core Scientific. So we are seeing shares of the company pulling back.
You know what's strange to me is Core Scientific,
okay,
right? So yesterday, Core Scientific was a $5 billion company.
Right.
And then CoreWeave said, we'll pay you $9 billion for that company. And today, Core Scientific is a $4 billion company.
Right.
I don't know how that math plays out. I mean, I know it's an all-share offer, but
that's what the street's trying to work out right now. I presume that's what I'm hearing from sources.
Well, Core Scientific holders will own 10% of the combined company. So I think what they're betting on, and Anurag Rana got into this with us yesterday, why not? The idea was there, sell now. These were the gains that we had of this company. We're not going to own much of the next.
Yeah. And Stifel, and as we're looking at what they're saying today, they're pointing toward potential dilution. That's what they're really flagging here, and pressure to multiples here. They're saying that CoreWeave is going to be really moving from an asset-light company to an asset-owned or hybrid business. So we are seeing a bit of caution out there in the market. But lastly, another IPO that we had been watching, and that's shares of Circle. We're seeing them down. They were initiated with a sell rating here at Mizuho, and we know that they actually had a 490% rally. And then we are seeing a sell rating that came from not only the bank that led the IPO, but of course Mizuho here today. The bank Mizuho is saying that they see a 25 to 30% downside to consensus revenue for the stock in 2027.
So much crypto.
Yeah.
So much crypto.
Wait, is your crypto show on today?
12 o'clock
Okay,
today.
tune in.
Right. Yeah, I will definitely be watching. All right, Nora, Melinda, thanks so much for the run through on stocks. When we come back, digital asset management firm ReserveOne is set to list on the Nasdaq via a SPAC. We're going to be speaking to the CEO, whom you may already know from her time running Hut 8. Jamie Leverton joins us next. This is Open Interest.
Now, President Trump's strategic Bitcoin reserve has moved the price of Bitcoin and opened up the crypto market to new entrants and opportunities. And of course, companies have gotten ahead on those reserves first. A new one, ReserveOne, the newly formed digital asset management firm, has today announced that it is listing on the Nasdaq by merging with the SPAC, as it sets out on its mission to build the digital reserve of the future. Joining us now to explain how and why, ReserveOne CEO Jamie Leverton. Interesting. You had really built your name in this business. You had run a big Bitcoin mining firm before. Why are we seeing so many companies do this right now? I mean, this is a sizable one to enter the market, but it definitely is the trade of the day, isn't it?
I think that's fair to say. And I think what we're seeing now is regulation really paving the way for a new type of investor to come into this space. You've probably noticed our board of directors has people, or our expected board of directors. We've got Chin Chu from CC Capital. So first time you're seeing a big name from private equity come into the space. We've got Wilbur Ross, who was prior a skeptic, now also joining us, expected to be on our board. So I think the clarity we're getting from regulators, which allows for broader participation by both retail and institution, is paving the way for what really is going to become our first wave of a regulated digital assets space.
I want to just break in here, and because the president has put something out on Truth Social that I think we need to share with our viewers, that there will be no extension to the August 1st tariff deadline. He put out a post saying, as per letters sent to various countries yesterday, in addition to letters that will be sent today, tomorrow, and for the next short period of time, tariffs will start being paid on August 1st, 2025. This is important because he said previously that may have been a flexible deadline, but it doesn't look like it is now. Jamie, let me get back to you and ask about the Trump administration's approach to crypto. Deregulation has been touted as one of the big benefits of this administration, and I suppose this is one of the places that investors really hope to see deregulation play out. How do you feel about the regulatory framework crypto operates in now?
We need regulatory clarity. I think we have it in Bitcoin, and that's really where we've seen Bitcoin kind of outperform since we had Bitcoin ETFs launch. But we've been waiting for regulatory clarity that we expect to come. And as you've seen the announcement, we're having Crypto Week next week, so expecting a lot to happen in Washington next week. And really what we need to see is the regulation that gives broader clarity to stablecoins, which we expect from the Genius Act. And then quickly thereafter, we need to see clarity get through to get that regulatory clarity for market structure, which really is about the rest of the digital assets coming into the space. And I think with that regulatory clarity, we'll see a lot more institutions coming in. We'll see a deeper professionalization of the space that allows for broader participation from the retail investor and the institutional investor.
So interesting. Crypto Week has made its way into kind of more traditional finance notes, which I find interesting. So certainly the core finance crowd paying attention. Now, ReserveOne is not just a strategic Bitcoin holding company. No. It's not just a MicroStrategy mimic. You're holding Ethereum, Solana, and potentially other tokens as well. How do you think about what you want to hold and how much you want to hold of it?
Yeah, so we're anchored in Bitcoin still. So expecting about 20 or about 80% kind of over the long term will be held in Bitcoin, but really taking some cues off what we're hearing from the federal government around the digital asset stockpile and the other assets that they intend to hold or maintain in that stockpile. So initially we've seen signals of Ethereum, Solana, XRP, possibly Cardano, and we really believe that there's an opportunity and a deep interest to have a diversified exposure to these types of tokens that are going to get support from regulatory clarity and potentially from direct holding or maintenance by the federal government itself.
Jamie, you ran HUD 8 for a long time, and the stock has done incredibly well. I think it's up 400% over the past 5 years. Are miners now going to shift from crypto mining capacity and use those GPUs and the infrastructure that you set up for artificial intelligence? Is that trend going to sweep across?
What was happening yesterday with
You're
CoreWeave
giving me
and Core
so much
Scientific.
credit, Matt, for the whole industry movement. Look, at HUD, I was one of the first to start that diversification into data centers, and the company continues to do so. Obviously, my friends at Core Scientific, big news with the CoreWeave announcement yesterday. So I think diversification will be increasingly important for the miners. HUD 8 had a great announcement earlier this week about their power infrastructure. So look, I think, but then Bit Digital this morning, I saw a big announcement of an Ethereum treasury strategy. So I think everyone's going to kind of choose their own path over time.
It's so interesting that there's so many paths now from what looked like a one-trick pony business. You know, it's amazing to watch what you did there, what Fred Thiel is doing at Marathon. You know, there's so many different off-ramps.
The crypto world and the AI world dovetailing.
Right. Well, if you actually think back to the very beginning, HUD 8 was the first public company to hold Bitcoin on balance sheet. I was the first CEO in the mining space to say we're not going to sell the Bitcoin we produce for the foreseeable future because we believe that Bitcoin has an accelerated path to creating value versus fiat, and that has proven to be the case. And so I think it's very natural that when the opportunity was presented to me to come and lead ReserveOne, I've been bullish on keeping these assets on balance sheet. I believe the market now has a real desire and appetite for something more diversified and also for something that generates yield, as opposed to what we've seen so far come to market broadly, single asset strategies that are passive. Michael Saylor, obviously an OG in the space, but he's repeatedly said he's not going to generate yield on his assets, whereas ReserveOne does intend to generate yield from, low risk staking and lending activities on our assets so that we can help cover the cost of our overhead and really grow the assets under management over time.
Jamie, we're looking forward to seeing exactly where this goes. That is Jamie Leverton, the ReserveOne CEO, new company hitting the market via SPAC. And be sure to tune in to Bloomberg Crypto today at 12 p.m. New York time. We'll talk a lot more about exactly why companies are looking to hold Bitcoin in public markets. Now back to that breaking news. As Matt was saying, President Trump says the August 1st deadline for tariffs will not be extended. He made the comments in a Truth Social post. We're going to bring in now Bloomberg Washington correspondent Tyler Kendall. What does this actually mean at the end of the day? He says that there has been no change, there will be no change. He's trying to clear up confusion. He says there will still be a lot more letters coming as well. What is there to expect?
Yeah, hey, Sonali. Well, according to the president, he's not going to have flexibility on that August 1st deadline. But it is interesting to hear these comments, considering yesterday when asked about August 1st, he said it was firm, but not 100% firm, appearing to show some sort of flexibility when it comes to negotiating with our trade partners. What this sets up now is this essentially 3-week timeline for these countries to put their best offers on the table and try to clinch a deal with this White House. He said to expect more tariff letters to go out today, tomorrow, and in the next short period of time. And our understanding was that the first wave of tariff letters really were geared towards those countries that this White House feels are the most frustrating at the moment to negotiate with. So we're going to be watching which of those next countries could see an updated tariff level and a tariff rate, and how this White House is going to be interacting with them. If we could see those tariff rates come down further or even hiked up.
All right, so no flexibility there after the post on Truth Social. Tyler Kendall reporting live from Washington. Thanks very much for that. We also have news on Amazon. If you look at those shares, they're hitting session lows now after Prime Day sales fell almost 14% in the first 4 hours of the event compared with the start of last year's sale. This according to Momentum Commerce. Bloomberg also has some great data on this. And, you know, one of the problems is a lot of brands aren't offering the kind of discounts that they previously have. I've been combing through my Amazon app to look for sales on certain things, and you just don't see them from the name brands as much as from the, for the most part, you know, Chinese-produced goods that they sell under various made-up names, just full of consonants.
And we should say also, I mean, big tech is having a tough trade in the market today, but Amazon is still down 2.2%. You could see why. Of course, this is a big set of 4 days for Amazon. These are just still the early hours, but to Matt's point, you're not getting the discounts everywhere. This data, of course, is according to Momentum Commerce, which manages 50 brands. That includes Crocs, Beats, Therabody, massagers. We will keep an eye on it. And Matt, we are done for today.
We are, but it's been great. Tomorrow, Morgan Stanley's Mike Wilson and David Kostin from Goldman Sachs.